Alright guys, I'm going to try something new today. I'm going to start my trading blog or vlog. So my name's Tom Spencer, I'm a derivatives options trader, and I am going to take you through a back test of a new strategy that I'm trying out using my platform. And if you've got any questions after you watch this, chuck them in the comments and I'll try and get to each of them. So I am using the implied volatility platform. It's available here in Australia. I've got a couple of different accounts I use, and they also offer a simulated account if you're not familiar with it. I have a simulated account here. I might make another video that explains these different components and goes through each chunk. What I'm actually really interested in doing today is doing a back test. So I've got this idea to improve one of my strategies. So I'll take you through it. The idea today is basically I'm running an Iron Condor index options trading approach, where I have two Iron Condors running on a 6-week rolling period. So at any one time there could be either one or two condors open for expiries coming up to 6 weeks out. I'll show you what that looks like in a moment. An Iron Condor, if you're not familiar, is basically positions on either side of the price of the underlying, where you sell and then you buy at alternating points on calls and puts to earn a total premium across all of the positions with a capped loss. And it performs quite well with stocks or indexes that have a relatively narrow band of trading range. So I use it sort of almost like a set and forget strategy. There are even index products in the US that you can use that basically just implement a version of this strategy, but I use it as a way to sort of get between 10 and 20% extra cash flow on my cash or shares that I own. This strategy, basically what I'm going to try and do is I'm going to try and tighten up the condor, basically narrow the band so it comes closer to the money, and then buy an insurance contracts underneath it. The goal being that I can be more aggressive and earn more premium, and if the market moves against me, I will either not lose any money or I'll actually make a little bit of extra money. And so overall the goal is to have it return a high percentage, hopefully like 25%. I still want it to be a relatively low management strategy, so I don't want to have to spend too much time doing it. And this backtesting tool is excellent for just trying to figure that out. First up, I'm just going to put in the code. So I only do this over indexes. The main reason for that is you can always get, in the Australian market anyway, it's pretty high depth relative to other things, not compared to the US. But then also you can get European expiries on your contracts, which is essential. I'll start with 50,000 just because that's actually what I will be trading on when I do this in the future, or if I implement this. And I might just go back a year. So if I start here, I can write some contracts. So this is the history. Zoom out a bit so it's a bit easier to see. The trade date set 50. Go into the cookbook. guys. They have this. Now, I usually set my deltas at 5. So a delta of 5 if I can, which basically is shorthand for 5% probability of being exercised at the current market volatility as priced by the options market. The powers that be that do that. And I usually try and get these as close as possible, 50 points, preferably 25 points. So let's move that down. Basically, I'm moving it down in the strikes until this goes to 0.5. But with this strategy, what I'm trying to test is, can I move it a bit closer? So can I get the band in which that I trade closer to, say, 10. If I can get it to 10, then I'll earn more, or I should earn more premium. So 75. Now what I might do is with the calls, I might leave those at 5. So push them up to here, a delta of 5. So we'll see, and it has a balance, liquidation value, total fees to put the trade on, rolling fees, max profit's only $600. Probably not really enough. Hang on, wasn't set correctly. There we go. 7.2, 750. Amazing, but take that. So that's $1,400 profit of this, potentially 23,500 loss if I get exercised. And I also want to buy my insurance legs. So all I want to do is just buy long puts way out, not too far, because then the market might shift. What I want to do is figure out a perfect cadence to be rolling my insurance contracts, so I'm not paying too much, because then I can move them up and down as the market moves. So if I think I'm doing this for January, February, March, April, I do it in May, 150 days, sort of half a year. Now, what I want to do is I want to get this sort of around my current position of my sold put. I'm going to see if that's a good spot for it, because basically I need it to, if the market moves against me, I need this to rise in value a lot. I need that rise to be sufficiently high so that it would either offset all of my losses or make a little bit of money. It's about as low as I can go. Okay. Now that's set. And with this, you can just go to expiry. What I would usually do in this scenario is I'll just zoom down and you can see what's happening as I'm walking this along. It's tracking the historical movement in the market and telling me what my profit and loss would have been at that time. Basically just concentrate on these strike prices, so 6,100 on the bottom, 7,200 at the top. Currently the market at that point on the 29th of December was sitting at 6,660. Now, as it's walking along, earning a return, about 6 weeks out, I'll set my next Condor for the February expiry. And I want to do it about 6 weeks, so this doesn't have slippage, it doesn't have a bunch of stuff that's sort of more relevant for like live trading. So for example, do I get filled at the right price, all of that sort of stuff, things that you sort of pick up as you start doing it for real. This is just assuming that every price is the price that I get. Might be faster to do this manually. Remember, the figure I'm going for is a delta of 10 on the puts, because I already have those insurance legs. Delta of 11, I'll take that to 6,000. And this is a delta of 5 at the top. Okay. Max is still 1,500. And what I can do is I can just jump forward a month. Now at that point, this Condor has expired and the premium has gone into my account. These contracts are still live. The insurance contracts. The return's gone back down. Am I pushing the top of this one, this call? It's about 500 points away. Now, getting to the point where I probably would want to set my next Condor. 6.6. Bounce back up. Now Feb, I'll be looking to set my 6 weeks out. I want to set my March Condor now, 40 days. There we go. Around the 10 delta. We set that down 50 points away. This one at a delta of 5. That's a bit too high. walking along. So we're going up. Now the value of that insurance contract is probably, like, it's expiring in May now, and we're in Feb. So the question now is when to roll that over. Do I roll it now? When I set it, my bottoms were around 625. Now the bottom is at about the same level. But it's deteriorating in value, so I could push it out, or I could just let it go and buy another one. Let's see what happens. That's the next expiry. So currently this is returned $3,000 on 3 months. What's that? All right, this is looking pretty good. All right, I could open another contract for April and just keep it going again. Probably do that around about here. What I'm really looking for is a market correction 44 days out to test this. What I'll do. All right, so fast forward. Just bring this back into the frame so you can see the updates. So after a year, almost a year exactly, this on 50,000 has returned about $30,000. So it's pretty good, and one of the specific moments that we're in right now in the back test is this correction. So there was a big correction in January, big correction, went from 7,600, and it's, after a bounce back, it's sitting at 6,998 or 89. Now with this tactic in place, I'll just zoom out a bit so hopefully you'll be able to see the top. The reason why this is showing the current balance is 77,000, but the net liquidation value, which is if I liquidated the positions, is actually 80,000. The reason for that is I've got one condor open. This one here is sitting at the February condor. The put side, you know, the open price is $27, 27 for that, $27. Its theoretical price is $58. So it's in a condor situation, you want it to go down. In this situation, the market's moved against me and it's gone up. My bought insurance leg has also gone up, so obviously that's offsetting the losses there. You would never write a contract like that unless you had the insurance underneath it. But then we've got this extra insurance leg up here that I've been writing consistently. So this one was set out in April. I was putting it at 150 days out. Its price has spiked to $343. So basically with that combination of that, I can close these positions and my insurance leg and make money in this situation, which is the ideal place, which means I have been able to write contracts closer to the money on the put side. But when we have a big correction like this, I can make money with that insurance leg. Now the key here is that you have to pick the moment when you clear the decks, because if you leave it too long and the market moves too far away, the amount that this will lose will move against you significantly outweighs the amount of money you can make back on the insurance leg. A good way to heuristic I'm trying to look into this kind of backtesting strategy is to probably look around the delta of 24.25 perhaps. See what happens if I left it later. The market would correct. I think the market corrected back. Yeah, you see the delta dropping down there, and the market recovered. Now we could just leave it like that and leave the insurance leg there, which could be another option. Like if we just keep it going. In the end, this insurance leg wasn't required, right? It didn't break through this position, but it's good to know that I can just close it, because in those moments, this is theoretical, in those moments it really does weigh on your mind when you're looking at the potential losses. At the time, this was like a macro kind of readjustment with the Fed saying that they can raise rates. So what I'll do is I'll simulate me closing that. And this. And this. And that takes the balance up to there. And then we keep going. So overall, that return on the Ready Reckoner we've paid $4,200 in fees over the year. We started with 50, currently at 80. Minus 50, so yeah, 30,000. 30,000 divided by 50,000 is a 60% return using this strategy. So definitely worth further investigation. I'm actually not live, I'm paper trading this tactic in my simulated account. So what will be interesting to see is how this strategy plays out. Maybe if I wind it back another year when we had very big movements with very long periods of sort of not much market movement, and then the year before where the market went down 30% and back up, and if it could survive that, both of those years, then I will probably move this into my live trading strategy.